Thank you all so much for coming. This is a huge turnout. We're so excited. We had a ton of people RSVP. So get to know your neighbors, please, while Sarah gets her affairs together. And let's talk a little bit about what you want to accomplish this year, what you're so scared of. And there are open seats in the way front, so whoever gets here last gets to sit here in front. No one wants to sit there.
Zone or something.
And usually we tell people, please silence your cell phones, but today it's interactive, so make sure you still have them with you.
Oh.
And Sara Glakas, everybody.
All right, everybody. All right, so I guess we'll go ahead and get started and see if we have like all the technology set up and everything. For those of you, this is a big group. This is normally our largest meeting of the year, too, by the way. So we like to kick off every year of the Austin Women's Investing Group with a review of the stock market. It's my favorite topic. So if I had my way, I would talk about it every month, right? Like over and over again. But also because like we find that when we're talking about investing and finance and money, this is one of the topics that has some mystery around it. How does it work? What should we do? What should we not do? All of those things. So that's why we always kick off with this one. This one, like Casey mentioned, the meeting will be interactive. We're going to ask you to take out your phones because we have some polls. Has anyone ever been here for our January meeting before? Where we like ask what you guys think, right? So we just want to like read the room, right? So we'll do some cool polls. We'll talk about kind of the stock market in general. I have so many charts and so many slides. I have 60 slides to get through. And Casey's looking at it. She's like, 60 is too many.
We're not getting through 60 slides.
No, I did carve out a few that are just like extra charts that I think are interesting. We might not get a chance to talk about them, but at least I'll be able to send it out to the group afterwards, right? We have 2 hours. I'm hoping to leave plenty of time for Q&A. To back up a little bit, this is Austin Women's Investing Group. For those of you who have never been before, I'm Sara Glakas. I'm one of the co-founders of the group. So my friend Michelle and I started this group in 2011, just as a way to get women in a room together to talk about investing, finance, and money, right? We used to meet in people's living rooms, cats and kids and wine and whatever topic popped up. But as it took off, and now we have almost 3,000 members, as it took off, we just had to find bigger spaces. So we've been using the Austin Public Library for several years now because we can have like this room and have plenty of places for people to sit. No one has to sleep on the floor or can sit on the floor, which is what people were needing to do at previous meetings. Just like a couple caveats, this has never been a problem, but especially with this one, we're talking about the stock market. Nothing in this room is intended to be an individualized investing advice, right? I am a financial advisor by day with Blackburn Financial, but while I am here, I'm just here to give you guys my opinions and my thoughts on things. Certainly, it's never ever been a problem since 2011, but just to be very clear, and we are recording this, that nothing is intended to be individualized investing advice. So always do your own research, your own due diligence, use common sense, do the best you can to research things. And certainly like use this as an opportunity to ask questions too, because I'll give you my opinion on things, as you'll see. We do have meetings coming up, so just mark your calendar for those. Follow us on, we have a YouTube channel that has recordings of past meetings on it. So now we have like quite a few recordings up there. We have a private Facebook group just called Austin Women's Investing Group. So we'll let you in if we can tell that you're not a bot. And we have an Instagram channel that we've been trying to post things to as well. So it's all at Austin Women Investing. All right, we're gonna see if this moves slides forward. Oh no, stop. Okay. Yes, great. Really quickly, we don't always do this. We don't normally do this, but for this year, we've asked the YWCA Greater Austin to come in. I've been involved with them for several years now, and we are on the cusp of launching what we're calling Financial Health Clinic, where we are trying to go into the community, offer low cost, no cost financial planning, low cost, no cost financial therapy, have educational events. For those of you who know me through the classes that I used to teach through UT's Informal Classes program, I'm going to try to start teaching classes now through the Financial Health Clinic. So launching, like, fingers crossed, in February with investing for nonprofit professionals. So trying to kind of hit we're here at the Austin Women's Investing Group trying to be a resource to people in the community. This partnership is hopefully a way to kind of broaden that reach. And so if you would like to join us, if you would like to follow us on social, Faye's in the back and has a bunch of different information. Faye Dedrick is the chair of the board back there. She's graciously offered to join us here. So we have a lot of information on that. It's a passion project for me. And of course, like YWC is a nonprofit. People often ask like how they can support the Austin Women's Investing Group. We don't take donations. We rely on volunteers like Lori, volunteers like Casey, Gwen, and several others of you. But if you feel that you could give a donation, $5, $10, $50 to the YWCA Greater Austin to get the financial health clinic up and running, that would be so appreciated. And also, if you think that you would want to volunteer, either as an expert, you have financial expertise. If you do not, and that's why you're here, then can you run a table or help people sign into an event or help coordinate volunteers? Like there's a newsletter and volunteer sign up sheet back there, Faye, is that right? Yes. So please sign up, follow YWCA on the socials so that you can know what we're launching in 2025. We're really excited about it. The financial health clinic, we're trying to raise $50,000 and we're, I think, about $22,000 of the way there, and we just launched it in October. So we're moving and we're getting a lot of really great feedback from the community. We think it's going to be a service that will help a lot of people in our community. So there you go. That's my plug. Okay, on to stocks. For those of you who've been into the Austin Women's Investing Group before, we're going to skip intros just because it's such a large group and because I have 60 slides. So hopefully you introduce yourself to your neighbor, sometime or meet up on the steps after we get kicked out of this place. But important information about this is webinar. I forgot to change the slide, but most important things to know about what we're going to be talking about. One, in investing, finance, stock market in particular, almost everything we talk about is forward looking, right? That's one of the things that's one of the hardest pieces for new investors to kind of come to grips with is, especially in the stock market, whatever's happening now is old news, right? New information from all over the world is being synthesized and processed instantaneously, and it's reflected in the price of stocks. So we're trying to make predictions about what's going to happen in the future. And we do that by looking at the past. But then we also say, out of the other side of our mouth, past performance is not indicative of future results, right? So basically, we're doing the best we can with the information that we have to make predictions about the future. This is not investment advice. We already talked about that. Hopefully, no guarantee of results, right? That's always the case in the stock market. And then there's just a bunch of other disclaimers here that I'll let you guys read in detail when we send out the slide deck. Here's just a little bit about me. I'm not going to spend very much time on this because you can look me up on LinkedIn or you probably already know me. And then we're going to get started. All right. So just to level set right off the bat, when I'm talking about the stock market, I'm talking about stocks for the long run. So we're not going to talk about day trading. We're not going to talk about trading at all. Trading in kind of in the financial world means making short-term buy-sell decisions based on some information that you think you have that will cause that to go in your favor. It's much closer to betting than it is to investing. So we're going to try to stay zoomed out and think about investing for the long run. What is the long run? I kind of put a 10-year time horizon on it, maybe 5, definitely 10, ideally longer than 10 years when we're talking about the stock market. And then Uncle Warren, our favorite investor of all time. I love this quote. It's my favorite investing quote. Someone is sitting in the shade today because someone planted a tree a long time ago. That's the mindset for the stock market, right? Someone has to dig a hole and someone has to put a seed in there and cover it up with dirt. And then we just have to kind of let nature take its course. It takes a long time to grow a tree, but it will eventually happen if you do all of these things. And then someone, hopefully it's you, hopefully it's a future version of yourself, you get to enjoy the shade in the future. All right, again, just a quick level set too, because I'm assuming there are plenty of beginners in the room, which is awesome. Stocks and the stock market. Stock is ownership of a company. That's really different than lending someone money, right? If you lend someone money, the idea is they pay you interest and then you get your money back, right? This is not that. This is ownership. So if you've ever owned a business or worked for a company where someone owns it, like you'll know that there are no guarantees, right? So that's really, really important in the stock market, no guarantees. The price of a stock, so we're talking about publicly traded stocks that we can see like on the New York Stock Exchange. Stock market opens at 8:30 in the morning, it closes at 3 p.m. Central Time. And during that period of time, all of the people in the world get together and they trade these, they used to be pieces of paper. They trade these pieces of paper back and forth, right? Like, okay, I will sell you my Apple stock. And you say, okay, well, I'll give you $300. And as soon as someone says deal, that's what the price is. Now the price of that stock is $300. There's no third party setting the price. The price is the buyer and seller agreeing to come to a transaction. Kind of the same thing if you think about listing your house for sale. You can list it for wherever you want, and you can think the value is whatever you want, but the price of it is what a buyer will give you for it, right? So that's really important. Supply and demand, right? All the investors in the world taking all the information that's being created and synthesized and making forecasts about what the price of that stock is worth. So that's why those stock prices are going up and down, kind of chaotically. And that leads us into the third one. Stock prices are always changing because investors' expectations about the future are always changing. We're just constantly getting new information. We're getting information, everybody in the world's getting information. We're using it to make different predictions about the future, and we're all in the same stock market. So some people are in it for the short term, some people are in it for the super long term. Some people are retiring tomorrow and they need to raise cash. Some people are starting their first job and aren't going to sell these stocks for 50 years. We're all in the market together. So it does, like that, again, it's kind of where part of the chaos of the stock market comes from. But the two major components of stock prices are earnings, which we will talk about, and confidence, or lack thereof, right? So we'll talk about that a whole bunch. And both of those things are always fluctuating over time. So in my humble opinion, the stock market is only appropriate for long-term money because these things are always fluctuating. Make sense so far? All right, so I'm just going to start off with the elephant in the room. As a financial advisor, I mean, going on maybe a year at this point, right? We have like one major thing on everybody's mind, so we're just going to address it up front. All right, so we've had some price volatility since election day, right? Like for those of you who were part of the group going up to election day, I think we talked about this, right? Whenever there's uncertainty, people get nervous and they tend to pull back on risk taking, and the stock market is risky. So typically you kind of see people get nervous and the stock market goes down into an election. And then once that election happens, the uncertainty is over, right? We know what happened. And then typically the market bounces back, and that's usually regardless of who gets elected, right? So we've had some price volatility since election day, right? So if we look at this, I think this date is a little bit off. So this is going through, I think, yesterday. We can see that right after the election, hey, all right, you know what happened? Stock market reacts, prices go up. Then some other things happen. People are like, oh, okay, but now what does this mean? If you read headlines, tariffs, tax policy, whatever it is, nobody knows what's going to happen next. People get nervous. The bond market gets nervous. Interest rates go up. Prices for the stock market come back down. And then some other things happen and markets come back up again since then, right? So we've seen volatility, meaning the price is going up and down since the election. I will say that if I look at this chart, I would look at this and be like, normal. Right? Like most of you would probably look at this and be like whatever, right? Like this is normal. So if you're not very experienced in the market, I'll just tell you, this is like pretty normal, right? So let's just talk about the stock market and political cycles. I want this to remain as emotionless and nonpartisan as possible. I'm just going to throw that off the bat. We are not here to talk about anything except the stock market. All right, so I'll show you the charts that I have. We'll take a closer look at the presidential cycle, a closer look at when GOP has control of White House and both chambers of Congress, and vice versa. And one chart that I think you must see if your main reason for selling is Trump or buying for that matter, right? So these are just like, I'm trying to synthesize all of the questions and the concerns that have come in over the months to just give you some numbers to look at. All right, so there's a lot going on in this chart. There is some evidence that there's something called a presidential cycle. So here we have in year one of a presidential cycle. Hold on, let me make sure I'm pointing at the right thing. What am I pointing at here? Okay, the dark blue line is the average over all of these presidencies going back to Hoover. So we can see like the average, like most of the time stock market goes up in year one. Then the average is it kind of goes sideways-ish year two. Then there's a big decline in big increase, I'm sorry, in year three, and then an increase going into year four. So this is just the average of all of these presidencies. Does that make sense? Yes. Here, the light blue line, this was Biden's presidency, right? It followed it pretty closely. Market went up after Biden was elected, then it came down, and then it recovered, and then it went up, right? So it actually kind of matched it. That might not fit with your worldview, right, or your feelings, but one of the points of these charts is so that we're not making investing decisions on vibes, right? That's like what people do a lot, and it will get you in trouble. So these are numbers, right? So if we look back since Hoover took office, the S&P 500's median performance during year one of the 4-year presidential cycle is up a little over 8%. That's like pretty close to average for like the average stock market return, right? With positive returns 58% of the time. I mean, 58% of the time is not a slam dunk, right? But it's better than a coin flip. So if I look at that, I'm like, okay, like just based on the presidential cycle, this year might be fine, right? For Republican administrations, so over here, I don't know if you can see this, like there's a lot of like Republican administrations that have really struggled in the stock market, right? So for Republican administrations, the median performance in year one is a decline of almost 10%. But 2017 was one of the up years, right? So if we're kind of looking back to what has happened in the past, then the first year of the first Trump administration, the market was up 19.4%, right? These other Republican administrations, like, oh, those poor guys, right? They really had to eat some pretty serious market declines, but 2017 is not one of those years. So that is some information.
Sarah, can I ask you a question? In 2024, does that end December 31st, or is that up until the election point?
Yeah, I think it's on the calendar year.
Okay.
Yeah. I mean, you can see it doesn't quite get all the way to end. So. Sarah, will be brought to you by ChatGPT. Okay, so if we keep going, let's take a closer look at, okay, what if the GOP has full control, right? So we have this like bespoke, by the way, and like I pay a lot of money for the subscription, so I'm like sharing this with you with their permission. But they put out like really excellent research, right? So they've highlighted here, like, okay, what if Republicans are in the White House, Senate, and House? That's happened 14 times. I think this goes back maybe since Eisenhower. So it goes back a pretty far way, but I can't, to 1901. So that's happened 14 times where there's been full GOP control. The average change in this is the Dow Jones Industrial Average, is 18.39% during that 2-year time period where there's been full GOP control. Does that make sense? The annualized return over that time is almost 8%, and percent of time up 78.6% if we're looking at the past. So that's like pretty good information to have, right? We can look up here and say, okay, same thing. What if Democrats are fully in control? That's happened 21 times. Dow Jones Industrial Average change of 17.3. That's, a little bit lower, but not that far off. Annualized return of 7.61%, and percent of the time up 66.7%. And then all the rest of the time, there's some type of gridlock, right? So again, kind of going back to if the past or if the future is something like the past, like this is also information, right? Based on that you can use to hopefully, again, it's making decisions on information and not just vibes, depending on what direction you're coming in from. I will say, like, these are the types of things we talked about in 2020 as well, when it was like, we're like half and half, right? So, of people being like very concerned versus very excited. So, you can look at both of those outcomes and say like, it's usually fine, right? And if we keep going with this, to the most important election-related chart of all time.
Can you move the TV? Do you have enough runway with the wires to move the TV slightly closer
Oh,
this
yeah,
way?
you move it up, yeah. Can I just move this whole operation up?
Let's just.
The answer is no.
No, no.
Lori, we're good. We just have to undo this a little. Just like my vacuum. All right.
Not too far, sensors. I'll make it easier to see all the little numbers.
Yeah, I do have a lot more small numbers than I normally have here. All right, so that brings us to like the one slide that has like very large font, the most important election related chart of all time. We looked at this last year, right? What do I need to do to make this move forward now? Down here. Okay. This again is from Bespoke, their premium subscription. We look over here on the left, $1,000 invested in the S&P 500 since Eisenhower was inaugurated in 1953. So in red, if you only invested when a Republican's president, your $1,000 would have turned into $27,400, right? So that's pretty good. If you're like, no, I only invest when Democrats are president, then your $1,000 would have turned into $52,100. And then you put it into context over here, and it says, what if you just had stayed invested the whole time and didn't make decisions based on who's president? That says $1.43 million, you guys. So I think we might look at this forever, like every 2 years, we're gonna look at this, right? Just to remember this number here, invested across all presidents, right? Any questions on the most important chart of all time? I love this one because I think it's like really clear, right? Very clear. We want to be green in your, non-financial life. You can be whatever color you want. Investing, we want to be green. All right. All right. So now let's get into 2025. I spent all this time talking about like investing for the long run, and then we just talk about the short run for a whole bunch of time. So that's what we're going to do. So bulls versus bears, 2025 market tug of war, right? That's kind of the consensus, is that you have these forces, some of them are pulling upward. A bull market is when prices are going up. Or bears, people who are bearish, like nobody's actually bearish these days, right? But if you are bearish, it means you think prices will go down by 20%, right? So there's this market tug of war. I shouldn't say that. I shouldn't say nobody's actually bearish, right? Because maybe, I don't know, maybe people are. So now we're going to take a poll and find out. So the question is, how will the stock market do in 2025? And I'm going to give you some options, and hopefully this works, and it does not. And hopefully it will when I do something else here and I click on something that hopefully magically works. And then it does. Yes. Okay, assuming I'm logged in here. Okay, so now if you could take out your phone. Again, this is something that we have paid for. So you will not be spammed, you will not be charged. Well, I don't know what your texting plan is, but you won't be spammed, you won't get any ads. We're not selling your information. So if you can use this QR code or the number up there, that 512 number, and text the number 1, the number 2, number 3, number 4, number 5, or number 6, it'll start polling or start collecting our results. So 1 is, how will the stock market do in 2025? 1, great. 6, terrible. So you don't really have to, you can, it's just like whatever adjective you would use to describe that.
Can you read that phone number all?
Yeah, it's 512-866-8020. And don't forget to hit enter, right? Hopefully you hit enter and then you get a response that says something like, thank you for taking the AWIG poll. And then in a couple minutes, it'll start tabulating our results. If I hit play. My bad. All right, now it'll start tabulating results. There are so many steps, you guys. That's gonna be a miracle if we make it through. But here we go. Okay, we'll leave it up until we get everyone kind of gets a chance to think on it and vote. This is always my favorite part of the meeting, is seeing kind of what the consensus in the room sort of is. We're also going to then go through all the slides and take the poll again at the end and see if anyone's changed their minds. Okay. All right, so 14 people have. All right, if anyone is still working on it, submit your votes. All right. So if I'm looking this, I'm like, oh, like, okay, like we're all kind of like generally like most of the people in the room were in the good to fine category. We have one person who's voted great. We have 3 people who are like not good, but we don't have anyone who said bad or terrible. Actually, a little bit surprising to me, but I'm here for it. All right. Very, very good. Oh, goodness gracious. Here we go. Okay. Is this going to work? Yes. Okay. All right. Thank you, everybody, for doing that. We're going to have more coming up. Okay. So in case you missed it the first time, or this several times we've done this in the past, we're going to kind of get in this Wayback Machine. We put this picture in here. It was so cool. We were contacted by the New York Times newspaper, the New York Times, about investing clubs. And so they sent a photographer to one of our meetings in January of 2020. So it was like our last meeting before we all got shut down, right? So this, look, I think I'm going to show you that same chart. And I managed to not wear the same sweater, even though I still have it, right? I'm looking at both leveled. But so if we go back through, so now we have like all of these cool word clouds that we've done over the past 4 years, and we'll do another one here, right? So back in January 2020, if you were there, we asked, why might the stock market do poorly in 2020? So now we're looking for the bearish case. Oh man, like nailed it, right? So we were right on this, wrong on that, right? But now we can kind of look back and see like, what were we all like thinking in January 2020, right? So there's some interesting stuff here. Then January 2021. Why might the stock market do poorly? Civil unrest. Right? Stock market actually did fine in 2021 as well. Overvalued stocks. We talked about that a lot in that meeting. January 2022. Ooh, we did actually really nail this one. Fed rate hikes, right? But I'm noticing up here, we don't have a lot of talk about inflation. We have one little inflation and fear. Inflation was the huge story of 2022. Basically, from when we took this poll until the end of the year, the market went down. It's very stone, right? As inflation went up. Last year, no, January 2023. What year is it? Okay. So this is interesting that after we were all ready for it, and then in 2023, we were ready for it, right? For inflation. And so it was still top of mind in 2023. Stock market did great in 2023, and inflation actually started coming down. Right? January 2024. So like we've just been talking about this for a long time, right? The election is top of mind for everybody. That was already giving people heartburn in January 2024. Stock market did fine in 2024. Actually did great. It was up like 24%. Okay, so now we're going to do a word cloud. If I can figure out how to do this again. So one of the things that the way the word cloud works is if we all use the same word. So you don't have to wait, but if you see the word or the phrasing of the word on the screen already, if you reuse the same one, it'll make it bigger. You don't have to do that. I mean, because it's your life, but that's just kind of how the word clouds work. But we're just trying to kind of see like, who had that queued up? That was very fast.
Yeah.
All right, stocks overvalued. Okay, so I'm seeing overvalued already. Tariffs. All right, as hit the board. DEI rollbacks is on the board. We have Climate change is on there, I saw. AI bubble is on there. Ooh, you guys are really good at this. I can barely keep up. We have tariffs in a couple places, it looks like, which is totally fine. We have overvalued keeps coming up. So let's just we'll give it like a minute so you can really think on it, right? Or come up with like, and it's all anonymous, right? So like whatever you're worried about, like just put it up there. Oh my gosh, all right. All right, this is really good. Oh, we have poor job market has made an appearance. And we had, there's something about war too.
Oh, yeah.
Yeah, war's in there now.
This is depressing.
We started with the bearish, right? Like you're supposed to kind of come up with like, this is the fears, right?
US isolation.
Income inequality, destroyed houses popped up there. Is kind of what's going on with like the fires and stuff. Is that?
That was my intention.
Yeah. Oh, debt made an appearance too. All right.
That's a worried people there.
Yeah. It's all right. Just let it all out. Rates have made an appearance too. Rates being high. That's interesting. Ooh, AI impacting job market. Anti-immigration policies and immigration is showing up in a couple different places. Oligarchy. That's good. I've never heard that term before. Oligarchy, yeah. Okay. All right. So we'll keep it going, but I think we can already like kind of see what the main themes are, right? Like everybody has a lot on their minds, right? But in the room, most people have tariffs and something related to Trump on their minds. And immigration is coming up big too, right? So this is like, these are the headlines too, that are the most prominent that everybody's inundated with, right? So that makes a ton of sense. All right. We still have a couple more coming in. Good job, everybody. All right. I'm going to pause that. We will get to the flip side of the coin. So kind of you can, you know, be thinking about the other side, but let's stick with the bear market for a while. Okay, so these are my bullet points, right? I tried to anticipate what I thought people would say based on what they've already asked me, but so these are my bullet points. These are the things that I am thinking about with the bearish case for stocks, right? And the first one, which didn't show up like a ton in our word cloud, was inflation, right? So inflation might be stuck or getting stuck. And if it stays higher than the Fed wants, rates could stay here or even potentially increase, right? Inflation was the main story in 2022 because it went up so fast. Inflation was also the main story in 2023 because it came down so fast, right? So inflation are connected to interest rates. Inflation and rates are connected to stock prices, right? They kind of have an inverse relationship. And that's true for all assets. It's true for your house prices. Your house prices, like all asset prices, almost have this connection to inflation. And for a really long time, we had very low inflation. And then we didn't, right? So we're all kind of like reacclimating to a world where we have to be concerned about inflation and thereby interest rates.
I was just about to ask if maybe we've just become so used to the inflation that it's just become so normalized that it's not even really impacting as much anymore.
One of the things about inflation again, this is, inflation is a rate of change, right? So I think we all get the sense like that prices are higher now than they were, right? And that has certainly been the case, like inflation, like prices went up fast in 2022 and even into 2023, but the rate of inflation came down in 2023. The rate of inflation came down in 2024. And in like the financial world, you're looking for the direction of change, not like the level. So 3% inflation historically is not very high, right? Like if you look back, but it's still pretty painful if you're living with it, right? Prices are going up by 3% per year. Certainly if they're going up by 8 or 9% per year, you're like, whoa, right? Like it, we may be getting used to it, right? But I think the markets are still going to be pretty sensitive to it.
Do you know the rate of inflation, like?
Totally do and have a chart about it. Yeah. 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 Inflation is also something that you can know very easily because they report rates of inflation, 2 different inflation gauges every month. So it's data that's coming in all the time. There's lots of quibbling about whether it's accurate or not. But if you're looking for directionality, and if you're also looking at the data that people in the market look at, it's CPI and PCE. They report it twice a month. You can even sign up for like apps from the federal government that'll send you those numbers when they're released. Now they have like inflation report days. It's usually on Wednesday. So like these are things you can know.
Well, and plus they changed how they measure it, so if you wanna go back 10 years, how they measure it then to now is different.
Absolutely. But the methodology is posted somewhere if you want to know it and how it's changed. Yeah. Absolutely right. Yeah.
If inflation is going down, I know that we do what's happening on that a lot of people would say the higher prices will stay at the price point.
Maybe.
So would that be something that would also affect stocks, or would that just be something that?
Maybe. I don't know.
Can you repeat that?
Yeah. Can you say it a little bit louder for your question?
Inflation, they found that, at least consumer goods, they found that people are willing to pay prices for goods that people are buying used to it, so even if they reduce inflation rates, that doesn't necessarily correlate with the cost of living or the price of goods going down.
Yeah. I mean, like, also, like, we measure inflation. No one actually knows how it actually works in real life. It's really weird because we talk about it all the time and we all experience it. But even like economists that focus on inflation as like a measurement can't predict what's going to happen, right? Like, how do we decide? Like, if we, you guys see this thing? There was this thing on social media with this hedge fund guy, and he posted a receipt for breakfast for $75.
Wow.
He was staying at like the Waldorf Astoria and ordered room service with an $18 orange juice and $30 pancakes, and then said, like, can you believe this inflation? Why did you pay that much money? When you could have like left your room and gone down to the street level and still maybe paid more than you would have a year ago, but that's like, so there was kind of this like, do people have too much money? And so they're not sensitive to whether they can afford it or not, right? Like, so there are all of these like, inflation is not well understood at all, and it probably never will be because so much of it is on behavior, right? How do we decide what to spend money on? Like, do you remember like post-COVID, like, and we're still with COVID whiplash, post-COVID, like the revenge spending. So it didn't matter like how much a cruise was or like a trip to Disney World, right? With your kids, you're like, I might never get another chance. So I'm definitely going to mortgage the house and take my kids, $25,000, right? And you're like, no, right? So like, it's weird.
A quick question. So
Yeah.
higher volatility tends to result in lower short-term returns. So can you speak to a little bit about what's the range on short-term returns? Like-
Yes, I have a chart, so I'll come back to
Okay,
it.
that's
Yeah. And then we kind of keep going through like the bear case, right? We'll talk about inflation a little bit more, tariffs, right? Can that reverse the progress of inflation? If If there are tariffs broadly, things get more expensive, that means prices go up, right?
I'm just gonna say, it seems like everything you're talking about is just psychology of people.
Interesting,
It's
right?
more than
And yeah,
numbers, it's just how scared are we or how confident are
Yeah.
we? Or-
that's why it's so wild and so unpredictable, right? Higher volatility, like in the short term, tends to result in lower returns. When prices go up and down more, people take risk off the table because they don't like volatility. Like, none of us like it. We want all of our stocks to go up in a straight line with no downside, right? So when there's downside, people pull out. So in the short term, higher volatility can often lead to lower returns going forward. We're going to talk about the yield curve, which maybe we'll talk about it, maybe we'll skip past it. I haven't decided yet. Higher mortgage rates are continuing to weigh on the real estate market, and the real estate market is very large. There's also, like, we're coming off a monster 2-year time period, monster in a good way. Like, the stock market is up something like 60% over the last 2 years off of October 2022. So could stock valuations be too high? That was in our word cloud. There's always like national debt, projected deficits. I'm not talking about that today. And decreased government spending could actually be a drag on GDP. We're not going to talk about that today either, but government spending is an input into gross domestic product. I still have 60 slides, even though we're not talking about a lot of that stuff, right? Okay, so this idea of inflation getting stuck at the end of December, like kind of going back to the post-election volatility, at the end of December, the Federal Reserve, who sets the federal funds rate, it's the very, very shortest term interest rate. The Fed came out and said, we think it's going to take longer to get to this target. Do you guys know about the Fed target? The Federal Reserve is trying to get the rate of inflation to 2%. That's its kind of official target. So if inflation is above 2%, it's too high. If it's below 2%, it's too low. And so they're trying to calibrate interest rates to get it just right at 2%. We're still too high, right? So here's our actual PCE. That's one of the inflation gauges. We're still too high. And they're thinking it's going to take a little bit longer than they originally thought to get it back to the 2% target. That means they're going to they could leave rates higher for longer, right? The Fed funds rate is, I should know this, no, 4.25%? 4.25%? The markets want that rate to come down because we like to borrow cheap, right? But if we're all borrowing money and spending it, that tends to, like, going back to like inflation and how we spend money. Oh, we're going to borrow at 3% and then buy the, $75 room service breakfast, right? So that's kind of how it is supposed to impact the economy. So this freaked out the market. They didn't like it at all when the Fed said that. But Jerome Powell started talking about how there's like evidence that inflation is not coming down as fast as everybody had hoped. Even though supply chains are now coming online, the supply demand from COVID is starting to even out a lot more. But this really freaked people out. Here's CPI, the other gauge of inflation. Again, this is from Yardeni research, which is free. Yardeni is a great economist who posts a bunch of free stuff on his site, but you could find this. You just Google CPI and can make a chart. So if we look here, here's like this is like our modern post-COVID era, right? In 2020 is this gray line, which is indicating a recession. So we see that inflation spiked up to about 9% per year and then came down very rapidly. And then there's this little like squiggly tail at the end, which is where we are now, right? It stopped going down rapidly. Everybody just hoped it would just go up and then come down, right? And then we'd be done with it, right? But we're getting stuck in this like little squiggly line area, and that's starting to cause people heartburn. I thought this was so interesting, so I just put this in here that they have been surveying Democrats and Republicans their 1-year inflation forecast, and looked at it's like, okay, like Republicans think inflation is going to be high, Democrats think inflation is going to be low. Then we get to the election day, and look how much it changes. Like, then Republicans think that like magically, like inflation is going to drop to 0, which is mental, right? And then Democrats are like, it's going to spike to 4.5. Like, I just thought that was so wild.
That shows
right?
the emotion.
It shows the emotion. So this is forecasts. And in mind, I put this in the bearish case, thinking if Republicans are making policy under the assumption that inflation is going to zero, that could lead to some bad outcomes. If you're like, hey, we can do whatever we want because we expect inflation to go to zero. Again, this is like on vibes and emotion, not information, right? Then it could lead to bad outcomes, right? There's not like I will talk about like the other case scenarios, but I just thought that was so interesting. Like
Finance, investment, educated people, or just.
that's a good question. I don't know. You have to look at who the University of Michigan is surveying, because I don't know if it's like economists or if it's just like people on the street. Like yeah. But that's really wild, right? That like all of these policies that a lot of people think are inflationary, if the people proposing them think they are so disinflationary that they'll solve inflation, that's just going to take some, like, you have to wrap your mind around that, right? Very interesting. And kind of going back to that with tariffs could increase inflation at the exact wrong time, right? So this is a chart, like this long-term chart of the trend line of where inflation was. So this gray line here is a 1.5% compound annual growth rate. So we can see here, like basically since the financial crisis, inflation has been like hovering above and around 1.5% annual inflation. And then in 2021, when it started kicking up, right, with all the fiscal stimulus that came into the system. So we discovered that when the government writes people's checks, it leads to inflation. Going back to behavior, you give me a check, I'll probably go spend it, right? So that kicked inflation up. It started hitting what would have been the 2% growth rate. And since then, you can see it's like trending upward. The slope has slowed down a little bit, but the slope is still steeper than it was back here. So we're just in a new era, probably, right? It doesn't really look like we're coming back to this 1.5% CAGR. So kind of going back to the point that someone brought up, it's been a while since we've been here. We've basically been in low inflation since the financial crisis. And now we're not. They have there's a sort of bond vigilantes in the bond market, which is like 3 times larger than the stock market. Bond investors will sell bonds if they don't think they're going to be able to recover the rate of inflation plus some premium. I'll just be like, nope, if we can't even beat inflation, then we're not going to own these things, right? So the bond market has a huge impact on the rest of the markets because it's how rates are set in the market. The Federal Reserve only sets that very, very short-term rate. The bond market sets all of the other rates. It's supply and demand. You can go to a bank and you're like, hey, I want to borrow at 5%. Right, like I'll give you a loan at 7%, right? Supply and demand. So the markets all pay attention to 10-year bond yields is one of the measures you can look at. 10-year bond yields went up by a lot. 1% is a lot in a short period of time. And during that period of time, the stock market came down. So this idea of inflation and rates is important, and it's so boring and it's so complicated. So I'm just telling you that it's important. Whether or not you choose to follow it, it explains much of what happens in the stock market. Again, going back to the tariffs increasing inflation at the exact wrong time, right before I did this presentation last week for the first time, there was this Bloomberg headline that says Trump team studies gradual tariff hikes under emergency powers. So the point being, like, this effect on the bond market and the stock market is not lost on people, right? It is not lost on people in the Trump administration. They, by and large, are Wall Street guys who know how the markets work. And that's not common in political administrations, but it is definitely the case as right now, right? So there's this story that the guy that's going to become the Treasury Secretary, Scott Bessent, and then these other people were starting to put into the media, like, what if we just bring tariffs up slowly instead of just like blanket 60% tariffs on everybody, right? And the market was like, I'm listening, right? They didn't like 60% tariffs on everybody, but as soon as like a more measured approach came in, the markets reacted to this headline, which was just a Bloomberg headline, which is kind of interesting to think about. With the hand, I don't know.
just like a terrace for dummies, like what is talked about? Text or whatever.
I don't know, because it changes all the time, right? Like sometimes it's like everything from a particular country, sometimes it's like a little bit from everybody. Sometimes it's like particular industries, but it changes all the time, which is part of the volatility. But nobody really totally knows. There's no like unified policy yet.
Okay, and it was not in there, like, if I was a business owner and I imported coffee beans. I would
Yeah.
have to-
There would be a price to bring them into the ports
Got it.
from another country. Yeah. All right, I'm gonna keep going, and we can always come back to this, but am I doing on time? Not great. All right.
There's a chart for that.
There's a chart for that. I talked about having a schedule like I do at basketball practice when I run my daughter's basketball practice, and I did not make one. Okay, so we're gonna talk about the yield curve for a minute. I'm gonna try to not spend too much time on this, even though I really want to. But because we've looked at this chart in the past, for a very long time, there's this yield curve inversion indicator, right? We've talked about this if you've been here, and maybe you've even heard about it in the news. The idea is when very short-term rates are higher than longer-term rates, it's called an inverted yield curve, because it's weird. It's why would I get 3.5% on a 3-month CD, but if I want to save my money for 10 years, I only get 3%. Shouldn't it be the opposite? And the answer is yes. That's called a normal yield curve, right? So an inverted yield curve, which is these areas down here, was and probably still is a very good indication that something's wrong in the market and a recession is on the way. It's a recession indicator. There was one false alarm until this most recent false alarm, right? So at the end of 2022 going into 2023, everybody's recession indicators were flashing red. And one of the main inputs is the yield curve inversion, right? The recession never came, right? And GDP that whole time was positive. There was never a recession, like a broad recession. So the other part of the yield curve inverting is like, well, what happens when it starts to uninvert? That is also a very good recession indicator, right? And so now we have the inversion, now we're having the uninversion. So we kind of have to think about, like, based on the track record going back when none of these recessions were caused by pandemics, is this time different? Right? I think there's a case to be made that yes, like the pandemic was wild. It caused wild reverberations in all of the markets, but it is very tricky to say this time is different in the financial world, right? So does that kind of make sense here? Like the yield curve as a recession indicator? So this would be a bearish case, right? That we haven't had a recession yet, but the yield curve almost always predicts recessions with very few false positives. So that's my bearish case. Price to earnings ratio is a measure of cheap versus expensive. Price to earnings, you put price in the numerator, the price of a stock, you divide it by the earnings that company generates, kind of like price per square foot, right? You can gauge whether or not a house is fairly valued, overvalued, undervalued by price per square foot. It's a very similar metric. So if we look here, this little magenta line is what we're calling the MAG 7, or this is actually the mega cap 8 in this chart from Edgar Denny. So these are the 8 big tech stocks, right? Microsoft, Apple, Meta, Nvidia, and all the other ones, right? And so their PE ratio, you can see, is very high relative to the rest of the stocks in the market. This red line is the S&P 500. So the magenta line is the largest 8 companies. The red line is everybody else. And then these sad little blue and green lines are smaller companies, small cap companies. So you can see that the mega cap companies are more expensive relative to your other options, but they're not as expensive as they were back here, right? But this is often like, do you want to buy something expensive, right? Or do we want to buy something cheap? Just because something's cheap doesn't mean it's good, right? Just because something's expensive doesn't mean it's bad, but you also don't want to overpay for stuff, right? Like being in the housing market in Austin in 2021, right? 22, rough. And you were like, I'm overpaying for this house and I'm doing it anyway, right? All right, yay, reasons to be cheerful. All right, hey, I think we're making pretty good time here. Okay, so same thing, January 2020, what were we thinking about? Reasons to be cheerful. We were just cheerful to be cheerful. We're just optimism and momentum and FOMO, right? So we've had a good market for 4 years, right? So like, let's just keep it going, right? This was the election year, right? So we have Trump in here. We also have Biden in here, I think, a couple, no, maybe we did. Maybe we didn't know about Biden. No one put Biden up there. So people like, there were reasons to still be cheerful in January 2020, even though we had big coronavirus on the other one, right? We had no recession. Oh, someone put normal yield curve on there. Awesome. Interest rates, new technology, new decade, 5G, like we had so many reasons. All right, in January 2021, here's what was happening. All right, so we had the election. So people were kind of feeling like coming out of COVID, like, okay, feeling of stability, they just feel good. Technology was making us optimistic. End of coronavirus, vaccines. That was all very good. January 2022. Oh my gosh. We were all so excited to be done with COVID. We all had COVID fatigue, and just like the examples we already talked about, we were all ready to get out there and make that economy grow. And we did not know what we were about to do, right? Inflation spike caused by our COVID fatigue. This acronym TINA stands for there is no alternative. This describes 0% interest rates. If you want to keep your money safe, you have to, how long can you sit on 0%? Right? People do not like that, right? So there is no alternative, so we gotta be in the stock market if we want to get a return, right? In 2023, what are we talking about? Oh, a rebound. Oh, yeah, rebound from 2022 is very bad. Big decline in the markets, right? So we were looking for the rebound a little bit. We were excited about the Fed stops raising rates. That was a big one. Recession not as bad, and then it got cut off. Rates stabilizing. We had low employment past the fear of COVID. Last year, we were still here. We had AI that shows up, right? Because what ChatGPT was launched at the end of 2022, right? So we're kind of getting used to the AI revolution. We were getting ready for lower interest rates. Overconfidence, yeah, we were just feeling overconfident, I guess. But and low interest rates were like the main thing, right? We were ready for that. All right, so now we have to do it here again. Reasons to be cheerful about the markets, just about the stock market, okay? And let me see if I can pull this up. We're back to the word cloud. Okay. Why might the stock market do well in 2025? I'm trying to, I don't know how to get this one off. Sorry, guys, I don't know how to make this go away. Settings, just go away, settings. Oh, here's my X. Yeah. Ooh, crypto makes an appearance, maybe first time ever. Lower regulations. Big tech companies continue to do well. We got some rates in there. We've got some innovation, tax cuts, corporate tax cuts specifically is what I saw. I did not put any crypto charts in here, by the way, so we might have to come back to that another time, but AI is in there, small business power, lower interest rates. Efficiency, layoffs, wars ending. Persistence. From labor markets in there. Wealth transfer. Women owning more wealth, yeah. All right, these are really good. All right. Thank you, everyone, for participating. This is like my favorite thing to do here. So we'll pull in a couple more, just give it a few more seconds. Got some mid-cap stock optimists in there. All right, perfect. All right. Again, I'm going to go into like what my bullet points were coming into it. So the bullish case for stocks, the stock market is in a bull market, which is kind of a cop out. That's the case for a bull market, is that it's in a bull market, right? But we'll talk about that. Earnings are trending upward. I haven't talked too much about earnings yet, but we will. And inflation is still trending downward, even though we just talked about how that might be a risk, it also might be a tailwind. Is it a headwind or a tailwind? Only time will tell, right? Technology-driven innovation is in early stages, and technology-driven innovation tends to be disinflationary. That means things get cheaper faster. There was just some crazy story about like a new AI out of China that cost, what, like $6 billion, 6 billion, like a very small amount of money relative to get up and running at a level that's at or exceeds OpenAI, which is incredible, right? That all of a sudden it's like some researchers at some university can get a large language model up and running with a relatively small amount of money. So that's disinflationary. The consumer is strong. They have jobs, low debt, and cash in their pocket. So we kind of already touched on that with our inflation story. Household wealth, we're going to spotlight some baby boomer wealth there. And then the US economy is still growing, right? This again is like, the data is out there. Is the economy growing or not growing? Like, it is possible to find the answer to that instead of just going on vibes. So we'll start with GDP Now and GDP forecasts. You could get this app from that for GDP Now from the Atlanta Fed, and they will just push these numbers to you. They'll push you inflation numbers, they'll push you unemployment numbers, and they'll push you GDP numbers. I know if you're a dork, so like you don't have to do it. Like if you don't care about the numbers, but I was like, oh, they released the GDP numbers. So what the Atlanta Fed does is they do this measure called GDP Now. Usually GDP is released for last quarter. So it's a lagging number, but GDP Now tries to chart it in real time based on a whole methodology that you could find out about. This is where, when we talked about this in 2022, about are we in a recession? And it was like we felt very strongly, people felt very strongly that we were in recession, right? Like we felt it, like there were layoffs, like and the market was down. GDP Now never got even close to zero, much less negative. It was always saying like the economy is good, right? Like it didn't feel like it, but if we were kind of looking at that, we might have said like, okay, what if there is no recession? What if we're all too pessimistic, right? So I think that just is interesting to know. Like nothing is foolproof, right? But that in real time, we talked about it here, we kept an eye on it. If the economy is still growing, chances are good that the markets will be fine too. They're not the same, but they are connected. The reason that we care about recession so much, like the human impact. During recessions, people get laid off, right? If you get laid off and you lose your source of income, the next step for a lot of people, if they don't have enough savings and can't find a job, is you sell your stocks. And so you get this like double whammy for people, right? Like you do not want to lose your job and sell your stocks after they've fallen 30 or 40%. It's just, that's how people get destroyed. We all know the stories, or maybe you've lived through it or experienced it, right? That's what the emergency fund is for. That's why it's an emergency. The stock market is forward looking. So going back to it being predictive, the stocks will have already fallen by the time you lose your job. So they are not a safety cushion at all. So recessions are very important in the market. In 2022, we had a 20% decline. We had a bear market in stocks without a recession. So it is possible, but typically when the market falls in a recession, that's when we're talking like 40 or 50%, right? It's just, you get that combination of people losing their jobs. If they don't have jobs, they can't spend money. If you're not spending money, money's not going to companies. They can't pay their people. They have to lay people off. Now, those people don't have money, right? So it's a cascading effect and it's very dramatic. So we do want to be on the lookout for recessions. Recessions are very bad, right? And the stock market will not save you from them. Right? The other, interesting thing about it is that, and it shows it on this chart, in most of these recessions, the stock market starts turning up before the recession ends, right? So just when you're like, I can't take it anymore, right? You sell your stocks, and very shortly thereafter, the market recovers and you miss it, right? So going back to stocks for the long run, you don't want to be in these little white recession bars trying to figure out whether you're going to sell your stocks and when you're going to buy them back. You just want to skip that whole thing if you can. Easier said than done. Okay, so going back to like stocks and like why their prices move, there is this very important relationship between price and earnings. Price is the number that we see. The S&P 500 hit 6,000. 6,000 is the price, right? Earnings are the profits that the companies in the S&P 500 made. We're in the middle of earnings seasons right now. I don't know if you guys follow that. We just started earnings season. So I think this week is mega cap tech. So a lot of big tech companies will be reporting this week. They come and tell you, and that's this blue line, how much money did you make last quarter? And then someone adds it all up and they put it on this chart and we can chart it, right? This is how much money the companies in the S&P 500 made. So generally speaking, if earnings are going up, the price of those companies is going up. And if earnings are going down, the price of those companies is going down. Yeah.
And the price of their stock.
Yeah, yes, yeah. So the price of the stock tends to follow the earnings or future projected earnings of that company. So it's almost like, not only did we do well last quarter, we think we're going to do better than expected in the next year, the coming year. And you learn that on earnings calls. Like that's the news that'll be coming in over the next month or so. So you can see here that that relationship is very tight. That's why earnings are important.
I just have a question. When I hear about projections and companies saying what they are going to earn,
Yeah.
Why do we believe them?
Because they know better than anyone else.
They're always telling the truth, or do they lie? Because why do they tell us they're going to do badly?
I will say, I don't think that in most cases, with the exception of fraud, that they lie. I think that expectations can change in business. The business environment can change. So you can have been overly optimistic and then you have to dial it back. But companies do not, if companies become known for lying, no one will have confidence and then no one will buy the stock. So I think that like analysts do try to suss that out. They also know which management teams, sometimes like management teams will overemphasize on the downside in one quarter just to get it all out of the way. We're just going to do a dump of all the things that are bad. Like Mark Zuckerberg is known for that. We're like, oh man, yeah, we spent a lot of money. We didn't make very much money. We're probably going to spend a whole bunch more. This is very hard, right? And the stock price will fall, but the idea is that you get all of the bad news out at one time and then build off of it. So it, like I think that most of the time they're telling the truth to the best of their ability because they don't know everything either. Some might exaggerate, some might under promise and over deliver. And so that's kind of where, like, if you're following an individual company, you'd have to get a sense for that, which is very difficult. That makes sense. That's just my opinion. I don't think that most people in management are lying, like in a fraudulent way, like telling you wrong information. That doesn't mean they can't be wrong about what they're saying, right? Tell you the wrong thing.
The oversight on it?
Oh, absolutely. Like it is fraud to say something materially wrong on an earnings call. Yeah.
Memberships
It's
kind of project what they think they're gonna have next year.
Yeah.
subscriptions in.
You are not allowed to lie if you know that it's false and you would go to jail for it. Or at least your company would be fined very heavily. There's lots of regulation around it.
I do understand the point of what you're saying, like, why would they tell people they're not gonna do well, like in a psychology standpoint, but your ideas also make sense, like, well, they would under promise and over deliver.
Yeah.
It's like a psychology, like.
Yeah.
I used to do SEC reporting for a public company, and they absolutely are not trying to get our phone.
Yeah.
Like, it's very much so, the analysts know what you're doing, so yeah, if you get into these trends, they're automatically gonna like average you up or average you down based on your trends. And so you just wanna be as predictable as possible, because you don't wanna make headlines. That's the goal.
Yeah, it's interesting. It's gonna fly under the radar.
Or maybe there's a time that they want to use their ego, which is what you're thinking of, like an individual that runs the company, their ego. They're gonna do that on their such and such a platform, but on their earnings call, their egos put in check is what I'm sort of flushing out
Well-
also by listening up.
Yeah, I mean, and also like on Wall Street, the only point is to make money. So if the information isn't true, you get one time to do that and your reputation is shot, right? Because whether it's headlines in media publications, that what you're releasing on behalf of the company, like it is, if people are using that information and putting their money behind it, so you get a very short rope to fudge numbers. Just in general here, right? Because if you fudge numbers and they're not true, a bunch of people are gonna lose a bunch of money and be very upset, right? So there's not really an incentive over the long run to lie or to fudge numbers. There's one over here.
Well, I'm just gonna ask, what would be the best source? I guess reading up the earnings call to understand if a company is overly optimistic versus being deceitfully optimistic.
Yeah, that's really hard. I mean, there's a bunch of like Wall Street analysts that follow companies. And they're like, okay, at like being able to predict what's gonna happen. There are a million financial publications. And then I would say that I think like the very best source is like, listen to the earnings call, right? Like you can get on the earnings call, you can listen to it and get it straight from the horse's mouth, what the people who are running the company are telling you. Because that's what the analysts are doing. They're on the call. And then if you're a high enough level analyst, you get to ask questions, right? So like the companies will report their earnings and all of their financials. And then there's a portion at the end of the call where analysts get to ask questions. And that's the most important part, right? You can tell based on the analyst questions, what investors thinks is important, right? So talking about like subscriber count, right? Netflix just knocked it out of the park because they had way more subscribers than anybody expected. And they raised prices on everybody and none of us noticed. Right, so that came out in the analyst call, right? So you can listen to those and they're an hour, maybe an hour and a half, and they're free and they're public. And like they're public for a reason because they're publicly traded companies, so they have to make all of that information public.
When you say earnings season, you meant every quarter.
Yes, I'm in every quarter during earnings season. So the company that you want to follow will already have on the calendar when they're reporting earnings. So a few of them, like a bunch of banks last week reported, but any company you've ever heard of, if you want to know when their quarterly earnings report is, just Google NVIDIA earnings, and you'll get the date that it's already scheduled and be able to tune in. Susanna, did you have one?
Sorry, no, next, I'll ask you later.
Awesome. Oh my gosh, I'm already at 41. Guys, we might have time for Q&A. All right. So long-term earnings trend, and going back to like the question about like the earnings, the earnings calls in the management, it is very difficult to project earnings for companies individually, right? Because each company has its own market, its own products, its own pricing, its own management, its own strategy. So here, these earnings are in the aggregate. So just to go back to, this is like all of the companies that in the S&P 500. So it's 500 companies that are all added up. And so when I'm talking about earnings here, is now we're looking at a long-term earnings trend for the S&P 500. We can see that most of the time, not all of the time, because there is a business cycle, in the aggregate, S&P 500 earnings tend to trend upward over long periods of time because the US economy tends to grow and trend upward over long periods of time. So if we look at where we are today, we have actual numbers for 2023 because that's already happened. We're coming up on being able to finalize 2024, but we can't finalize 2024 yet because companies are still reporting over the next few months. But this is where we think it's going to come out, this box. And then people, again, we're forward looking. We don't even care what happened in 2024. We only care what's going to happen in 2025. And now we're already starting to look out into 2026, right? So we're just like always skipping ahead. So these estimates are for 2025 earnings and 2026 earnings. One of the questions that maybe like you're all thinking is like, are these accurate? Does anyone ever project earnings going down? The answer is no. With the exception of during COVID, these earnings, the earnings estimates for 2022 and 2023 were like way down here. I don't know if you guys remember that. I could probably go back and find what the chart was. But certainly that makes sense, right? Like, oh my gosh, like we're all like living we're just in our houses, not going anywhere. How are we going to survive? Things are going to get worse before they get better. So typically the estimates are kind of in the direction that the immediate trend is. They don't catch turns very well. That's why we all get caught flat-footed when the market goes down. What we thought was going to be awesome. Sarah showed this chart. It's going to be awesome, right? But we don't know the path over the long run. Like it's going to zigzag, probably like this one is, right? But we just don't know when that's going to happen. That's what makes it so hard. And that's what makes the short-term prediction piece so hard, right? Like if you're trying to figure out like how the market's going to do in 2025, it's like, okay, the box might be here, it might be here, it might be here, right? And so if you're just in the market for the next year, this is not like the room to be in. I think it's good to like be prepared and to know what the outcomes might be, but the boxes are never in actually the right place. Sometimes they're underestimated. The last couple of years, like these boxes were underestimated. The market did better than expected, right? So we have to take it all with a grain of salt because we don't know what's going to happen, right? Here's coming back to inflation is still coming down. I think we've talked about this a whole bunch. Here's our little tail here at the bottom. Again, like looks like it's maybe getting a little stuck. There's even a little like uptick there at the end. So that this was the bearish case, is that this little tail is getting stuck. But if we just look at it, the bullish case is like, but it's still like, you can eyeball it and see that it's still trending down, at least for now, right? Back to my bull markets are a good indicator for a bull market. Bull markets can last a long time, right? And probably longer than anyone expects. So this is a chart of bull and bear markets going back to 1928. You can see there used to be a lot more bear markets back in the day. Like the markets are just different in the modern era than they were back here. That was kind of pre or right around the time the Federal Reserve was even created to prevent recessions and financial crises. Like in the 60s or in the 70s, we went off the gold standard. That was pretty major, right? But in kind of this modern era, recent past, you can see that these bull markets, which are the white space in between the red bear markets, can be very long. So just because we've been in a bull market for 2 years does not mean there's like an expiration date, right? One of my favorite market sayings is bear markets take the elevator, bull markets take the stairs, right? Bear markets are fast and so painful. And that's what flushes most people out. Like, nope, do not like, let me out, right? And then bull markets take the stairs. So it kind of looks like this check mark, right? Here's a little check mark that maybe is starting to happen. So bull markets kind of tend, as long as nothing goes really, really, really wrong, they can last for a long time.
In regards to that, so would it be reasonable for people who are like prepping for retirement? So they've got like a year out and like something like this happens on a bear market goes down. Yeah. So would it be appropriate for that particular audience to get out?
Absolutely.
Okay.
Or to modify their their plan. And I do have a chart for that if we get. Okay, because that's exactly right, right? Like, do you want to be a year out for retirement and have your retirement plan based on whether the stock market does well in 2025? Like, don't do that.
Maybe even 1 to 3 years or something, but if you've got like 5 more years or something, perhaps hang out.
Yeah. Yeah. And then over here, just if you want to take a closer look, this tells you in days, the length of time that these bull markets lasted. Right, so our longest one. I mean, so we have some of these that exceeded like 4,000 days. Right, the average is 1,000 days. The post-World War II average is almost 1,600 days. So they just last a long time, yeah.
I just want to make sure I understood your answer to that question.
Hmm.
You're not saying because you're at the front of a bear and you want to retire, sell stock.
No, I think that like what I'm saying is if you are getting ready to retire, why take the risk? Like why, like you would start carving out, regardless of what you thought the market was going to do, you start carving out money to live off of. Because if, for most people, like, okay, I'm 65, I'm going to retire. I have $1 million. You don't want that decision to hinge on whether you have $1 million at the end of the year as well. Right? If the market falls by 20%, you have 800,000, are you going to make the same decision to retire? So there's a behavioral, I mean, and certainly a financial aspect too. There's something called sequence of return risk, which is that you start pulling money out of your portfolio to live off of when the market's going down. And so you're selling lower because you're like, I'm just going to stay in all stocks. I'm just going to sell stocks as I need the money, right? If you're doing that as the market's going down, you're selling low, right? So
Should
there's
they
a
sell the
specific
whole million
aspect.
though?
Oh, I would say most of the time not. Was that the question? Like just get all the way out? Like, sorry, it's more like building up like your cash stash. So you go from a
To sell, it's feeling uncomfortable.
right. It's instead of your 6-month emergency fund, because I might get laid off and then I'll get another job. It's like maybe like a 1 or 3 or 5 year emergency fund so that I'm just paying some bills. The market's doing whatever it does and I'll replenish it when the market gets better. That type of plan. Okay.
So, what you're really trying to right is, or the time you want to start thinking about it is how you start changing the risk level that you talked about. And yeah, as you're starting to try to figure that out, you're gonna start changing how you save, how you invest, how you deal with, and change the risk level and give yourself more cash as you go along. That's what I had to do.
Yeah. I mean, but and it also ends up, it's a little bit of a different mindset from when you're accumulating. Because if you're not trying to predict where the market's going, you're saying, this is me. Like, I am now going through this transition. I would like things to be perfectly stable for this whole year while I go through this transition, or 3 years. I want it to be more stable, maybe not perfectly stable, but more stable. And I'm willing to give up the upside. I don't need the upside, but I really would like to avoid a certain amount of the downside.
But you're
So
also
really
gonna
good question.
freak out. No, when you finally get ready, where you are retiring and you no longer have a job, you've been saving all your life. You've been trying, you've been going, you've been investing, you've been doing all of this stuff, and all of a sudden, now you're going to spend it.
Yeah.
So your first, even though you have been preparing and you got the money, you can deal with whatever, it's like, your first thought is like, wait, how do I choose to take this?
Yeah.
So yeah, you're gonna freak out a little bit, but it'll be all right.
Unless you're pulling out of your emergency fund. And you're not having to pull and it doesn't feel good to pull.
Exactly. You never want to be forced into selling, right? Anything.
And so the emergency fund should never be considered that my emergency fund is in
Oh
stocks.
my gosh.
My emergency fund is in my
Yeah.
Wells Fargo bank
Yeah.
account.
Or like, I want to
Or
make a down
selling.
payment on a house next year. Should I put it in the market, in the stock market? No.
Okay.
Because it can go, just always, just think it can go up 30% or down 30%. If it goes down 30%, is that going to ruin your life or your plans? Like, it depends on the plan, right? So yes, I mean, the volatility is just too much in the short term. For any, it's only long-term money. So we can get through these ups and downs. Really, really good questions. And like hitting on the nuance of like the stock's role in your financial plan. So going back to like an AI driven bull market, I think this is kind of interesting. This is showing this current stock market, which is the red line, versus the one that's the bull market that started in December 1994 when Netscape was released. Like there was an internet, right? But Netscape made us able to use it, right? So like there was artificial intelligence before October 2022, but ChatGPT showed us all how to use it. So I think this is kind of interesting. But trading days down here, so this goes out, that bull market went for 750 trading days. Or it's showing 750 trading days, and it looks like relatively similar. This doesn't mean it's going to end here like at exactly the right time. It's more like conceptually, these things can play out for a long time. And then every once in a while, or like more than every once in a while, people are like, should I be getting in at all-time highs? Right? Because we're at or near all-time highs. So I like this chart because it shows that 64% of the time, the market is within 10% of all-time highs because the market trends upward, right? So if you don't want to invest when it's at or near all-time highs, you're going to miss out on most of the times to be in the market, right? Like these downswings, again, bear markets take the elevator, bull markets take the stairs. Some people kind of come in with an idea like, I'm going to wait for the market to fall 20%. Then I'm going to get in, right? And then you're like, okay, what if it falls 19.5%? Close enough? Not close enough? And then are you going to be paying attention at your work computer on the day that it happens? Probably not, right? It's because these things can happen. I mean, look at this little one from like 2020, like that bear market lasted a few weeks, 3 weeks. And we were all freaking out.
Yeah.
Right? So that you will be freaking out too. Are you actually going to have the nerve to pull the trigger on your plan when it's happening? Because the reason it's happening is we're all freaking out.
Yeah, while
So
you're busy Cloroxing your groceries.
It's very tempting at all-time highs to say, I'm just gonna wait and I'm gonna buy the next crash, right? And then come back to an Awesome Women's Investing Group meeting during the crash when we're all like, I'm just staying in, I'm just, but we're all feeling very dumb at that period of time. And like we did something wrong, right? Are you gonna be ready to jump in when you feel that way too? You're gonna be like, hey, I'm all in cash. I'm just gonna sit in cash until things get better, right? And by the time things get better, the market's already rebounded because it saw the better times coming. So it's like, don't do it. So this is like where the 401k and then like regular contributions to your IRAs and dollar cost averaging come in. You're just putting a little bit in the market all the time. Sometimes the market's at all-time highs, sometimes it's at low, sad lows, and you're just always putting money in over time versus trying to time it out. Oh, bits and bobs. Okay, these are just charts I thought were interesting. So I'm just very quickly going to move through them, and then you can take a closer look when you get them when we email them out. So I like this one, like this U.S. economy's secret weapon, seniors with money to spend, right? So let's look at baby boomer wealth. Is this piece of the pie, right? So that article is talking about how, let's see, almost $80 trillion.
Yes.
$80 trillion controlled by baby boomers. Right. So baby boomers have a lot of money and a huge ability to spend. It's not literally like every baby boomer, right? In the aggregate. Up here, we have Gen X. Yeah. Right? And then our millennials up here. Oh. That our silent generation down here, right? Where that's kind of been hanging strong for kind of a while. But just because of like the natural like cycle of life, like we can kind of imagine what they're already talking about, which is a wealth transfer, right? Because a lot of money.
The silent generation is 79 to 97 years old right now.
No.
So yeah, it's gotta change eventually.
But I think that was really interesting, just like framing it like, hey, all those baby boomers, they're in good financial shape, right? And we don't talk about it, right? We talk about it in terms of like mortality or But even if you're like, oh, like, okay, what are the industries that you want to be in? It's the ones that the baby boomers are going to move into, just like from a population perspective, but it's a money perspective too, right? So I thought that was interesting. Excess demand for labor. So this part is just jobs. You can see most of the time, there are more people looking for jobs than jobs available. This goes all the way back to 2000, right? But here, we have more jobs open than people looking for jobs, which is interesting. It's kind of been that way since COVID. So if you want a job, there are jobs available. It doesn't mean it's like in the location you want, right? Or the exact job that you want, but that there is still like a mismatch there, which is interesting. Vehicle sales. People don't buy cars when they're in financial distress.
Oh, I didn't want to skip too long from the baby boomer.
Oh, sure.
But I keep on seeing where people are suggesting you to start looking for businesses because baby boomers are going to sell their.
Oh, yeah, I think that too. Yeah.
So
Yep.
that's.
If you have, there's someone, who is the woman that just wrote a book on that. It's like finding, the only example I can come up with is like a dry cleaner.
Cody Sanchez.
Yeah.
Yes,
What?
Cody Sanchez.
Yeah.
Did I hear her on like Scott Galloway's podcast?
Yeah.
Is that it? Okay, you know what I'm talking about, yeah. So the idea,
I didn't hear.
it was baby boomers with businesses who want to exit. So if I have a small business, like a dry cleaner or a restaurant or something,
Sign maker.
yeah, something like that cash flows, that there's an opportunity for people to come in and buy those already operating businesses from baby boomers who want to retire. So there's like kind of a whole like cottage industry around it.
A passive income.
Yeah, you still have to work though.
Yeah.
It's not passive, but it's like, it's like a stream of, but it's already established,
Yeah.
like an established cash flow that then you have to keep going versus creating something from scratch, right? Yeah, I think that's interesting because that's in here too, right? This is wealth, like total wealth. Vehicle sales, strong. So like I just mentioned, people don't typically buy cars when they're in financial distress or are worried about being in financial distress. This is one that kind of always surprises people. Households have a relatively low debt as a percentage of income. Like one of the things that we talk about a lot, I think again, it's like a feeling, is that people have too much debt, right? You might know people with too much debt, but in the aggregate, households use 11.3% of their disposable income on debt payments, which historically is not an overwhelming amount, right? Like there's this whole like, ooh, yikers, right? Like this is kind of post, like leading up to financial crisis and then after the financial crisis. And you can see here, like during COVID, people took their stimulus checks and a lot of them paid off debt with that, right? Yeah.
So Sarah, does that mean that, is that chart just for homeowners?
No, it's households. So it doesn't matter like what the debt is, like just
It
like.
doesn't
in
matter
general.
where you live, it just means like a family unit.
Yeah, just households like in the aggregate, like are not in the aggregate overly debt burdened.
So is it, sometimes the mortgage.
I have that down here. No, I don't have it down here. It's all debt service payments. So mortgage. I mean, think about all of you people with your like sub 3% mortgage rates, right? Mortgages, cars, credit cards, student loans, all that. So I thought that was interesting. It kind of just flies in the face of the like, oh, everybody has too much debt argument. Real estate affordability remains a challenge for those of you in real estate, like as a profession or trying to buy a piece of real estate. It's just tough out there, man, right? At these rates. So sorry. Okay, all right. So now we have one more poll, right? So like remembering back to what we said at the beginning, we were all kind of like in the middle. What do we think in 2025? So now let's do it one more time and see if we're in the same place or if I've convinced you one way or the other, or if you saw a chart that freaked you out in a good way or a bad way. All right, so same thing. It's the same number. Text 1 if you think it's going to do great. Text 6 if you think it's going to be terrible. Yes, there are more people voting. That's true. Yes.
14.
All those pessimists were scared away by the first one, but now they're.
Great to put him.
Some people just figured out how to vote. Was under the wrong tab.
All right. Okay, so assuming that our pessimists just couldn't
Push the button.
push the button. It's the distribution is kind of similar with a few more very bad ones. Yeah, but a few more great ones. Very interesting. Oh, get out of there. Just go away.
It's also like, the last things we talked about were the upside, so you forget about.
I know. And now I can't remember if that's the order I always go in, because I'm also like a natural like stock market optimist for the long run. So if it's bad, it'll be fine later, right? So I think that part of my like natural, like persistent bullishness is always in the presentation, which I try to take some of it out, but.
Sarah, is there any way to make that, poll, not show up until everyone's done?
Oh, that's a good idea. Like, so you're not like swayed by the rest of it. That is a good idea, Ginger. Next year, I'm gonna keep it secret and then reveal it at the end. Yeah. Okay. Good idea. Okay, so like just a couple, like now we're gonna like kind of zoom back out. We zoomed out, we zoomed into 2025 and are just zooming back out, like the role of either the role of stocks in your portfolio or the perspective that will make you a more successful long-term investor. There's always a crisis coming, always, right? So this goes back to 1928 and there's just, you maybe can't read them, but like Pearl Harbor attack, 1973 oil crisis, Bernie Madoff arrested, Iraq war begins, first US case of COVID, Russia invades Ukraine, right? You can take all of these headlines and all of these things that are very serious and feel very serious at the time, and you can put them all along a stock market chart and try to put it in perspective, right? There are some crises that do turn into a financial crisis or a stock market crisis, but there are a lot that do not, right? So like with headlines, I feel like keeping the long-term perspective. One of the things that I just like to remind people of is that we are all here, we're in the US, right? We're investing in US dollars, we're investing mostly in US companies. And our entire country is built on capitalism, which incentivizes businesses to figure out how to make money. Because if they figure out how to make money, owners get to keep it. Whether that's the right system or not, it's how our entire economy is built on it. So if the incentives continue like in that direction, and we're living in a capitalist economy, then the assumption should be companies will figure it out in the aggregate. Some will not figure it out and they will fail, right? Their technology won't be good enough, or they commit fraud, or they're on the wrong side of history or something, right?
Keep evolving.
Yes. But the ones that fail are immediately replaced by someone who has figured it out, right? So that's like creative destruction process is what this all is. So whatever the crisis is, I mean, so like in COVID, like remember the companies that were incentivized and given money to create a vaccine, right? Like that's, you should assume that companies will figure it out. Maybe not, like if you pick one company, like you might want to be a little bit careful because what if your company doesn't figure it out, right? But this is like the S&P 500, right? So the 500 companies. The 500 companies that were alive during the Dust Bowl are not the same companies that made it to the end, but that doesn't matter to you. You owned just the S&P 500 that whole time. In your basket, companies are dying, companies are growing, replacing, and you don't even have to think about it, right? You just have to be able to gut through these terrible times and then ride out the up times. So we can always do this, like nothing is unprecedented. I love this quote, never bet on the end of the world because it only happens once, right? We all kind of do that, right? Like this thing will change everything forever to the downside, right? Like, it's tricky. So just try to kind of keep that in check and like reference back to this chart. Back to uncertainty and higher volatility. In the short term, stocks tend to have lower returns with higher volatility, but over the long run, the volatility is what gives you the higher return. It's a feature, not a bug, right? If you want to be perfectly safe, you get an FDIC insured CD that pays you now 4.2%. And that's all you get. No more, no less, right? Because this is the daily price change is this gold line, right? So here at the end of March 2020, we had a day in the stock market where the price fell by 12% in one day. If we go back to 1987, which isn't on this chart, Black Friday, the S&P 500 fell 20% in one day, right? Like that's like not cool, but it happens. Like now they have circuit breakers where the stock market will shut down for a few minutes to give everyone a chance to like compose themselves, pull it together, people, right? But like you should expect that you have these massive spikes, and then you will hear it on the news. And this massive spikes are almost always to the downside, right? Again, the bear markets take the elevator, bull markets take the stairs. Market falls by 12%, and then it goes up a little bit for a long period of time to recover it, right? And you will hear on the news, market crash today, everybody's freaking out. Should we be freaking out too? Like, hopefully not. But that's why you get the higher expected rate of return over time. We expect the stock market to double every 7 to 10 years. It's not a guarantee. It's not clockwork. Sometimes it's 5, sometimes it's 12, but that's what we're going for, right? It's a 7 to 10% annualized rate of return. And it has historically over a long enough period of time been about 10% per year on average. Never actually 10%. Up 30, down 30, averaging 10% over time. And so if you don't like stocks, what are some alternatives? Oh my gosh, I have so many favorite quotes, you guys. This is my new favorite one. I certainly wouldn't invest in the stock market. I never believed in it. Most people lose money because of the emotional difficulty involved. Bernie Madoff said that. So funny. He invented a way to give people a stable 12% rate of return. Right? So if we look over here at our different asset classes, the green line, this is going back to 1993. The green line is the S&P 500. 9.83% annualized. That means an average of 9.83% per year. But we've got some other things. We've got gold, which has done great in the recent past, right? But still, over that long period of time, doesn't compare to stocks. Not a replacement for stocks. We have this little purple, nice purple, like stable line here. That was the US bond market, which has struggled over the last few years, but going back to 1993, pretty stable. Not even close as far as rate of return goes. Our blue line is real estate, so like your house, residential real estate. Nice and stable. Total rate of return not as high, right? And then our gray line is commodities, so think like oil and gas, cattle,
No
meat,
mattress?
things like that. What's that? No mattress on there. But we should have put cash on there. I mean, it would probably it would look straight across, right?
Except you lose money.
Right, not this is not inflation adjusted, like to that point. Yeah.
Not buying savers.
Yeah.
10 years ago.
Right. So like, what are the alternatives? Most of us don't start out having enough to retire, right? Some of us don't end up with enough to retire. So we're out there doing our best, we're earning money, we're taking our savings, and then we're trying to put that savings somewhere, and we need it to do something. If we already have enough, we just need it to stay safe. So maybe it's an interest, right? Or maybe it's a CD, whatever it is. If you already have enough, wealth preservation. This is actually where financial services hones in on people who are already super rich and just want to keep it, right? The rest of us are out here like, well, how do we get the super rich part, right? We're taking our little bits of savings and we're trying to find the thing that will do some of that work for us. So it's not all like brute force of us saving and working until we die. So that's like where like the role of stocks is in my mind, right? And why it's important for more people and more women to embrace that, right? And understand the risks, but also understand like what we're going for, which is having enough, right? So thoughts to take with you. Okay, I actually forgot about all these slides. So thoughts to take with you. You don't have to know everything. Capitalism is flexible, it will adapt to changes. Stocks have always been long-term wealth generators. Do you need to generate wealth, or are you already wealthy? What we just talked about. Short-term predictions are so very hard, right? We have never really been right in this room. Advisors were basically guessing from year to year, right? Trying to get you to the long term. Analysts, stock market pundits, it's all like a lot of forecasting, which is guessing, right? The system is too complex to be predictable. And even if you get a prediction right, you can get the outcome wrong. So think back to 2020, how fast things moved. Market crashed. Oh my gosh, I wish I would have gotten out. Would you have known to get back in April 1st, right, of 2020? Probably not. So if we can kind of skip the jumping in and out and making short-term predictions, we will be better off. So how do we prepare if we can't know how the markets will react? That's spending time on things you can control, right? So this is Casey. She's a certified financial planner. She like listens to me talk about investments all day, and then she's like, just plan for it. Like just like put together a financial plan. So investments are just part of financial planning, but financial planning is not just investments. You look at everything around you. You look at your income, you look at insurance, you look at, do you have a pension? You look at your tax situation, you look at all of these other pieces around it. And those are things you can really make very effective decisions on. So you get into the financial planning world, right? What are your financial goals? Being really crystal clear on those as soon as you can. And most people don't have crystal clear financial goals, but the point is that you're thinking about what you need your money to do, right? I need it to protect myself. I need it to protect my loved ones. I have kids. I have parents who rely on me. Like, what are your goals? Your emergency fund. So we just talked about that, right? When you're working, you need to be able to get from a layoff to the next job without selling your stocks, because your stocks will very likely be down. And then depending on, we talked about retirement, right? Maybe raising more cash if you're ready to transition to retirement. Monthly expenses, knowing where your money is going and redirecting savings towards financial goals. That's budgeting. It's like, we try to do a budgeting thing every month, or sorry, every year in Australian's investing group, and I find it so painful, like personally. But a lot of people, some people like it, most of us don't, but we should do it, right? Up-to-date estate planning and insurance planning. That's just taking care of yourself and your people in case something really, really bad happens. Oh, commercial. Here we go. So cute.
Great picture.
Yeah, thanks. I'm sure AI did it. I'm joking. We didn't actually. We did a photo shoot. And so questions. Oh, there's no chat box. Here's my information here if you wanted to have like a one-on-one about things, but I think we actually have time.
We have 9 minutes.
We have 9 minutes before we start with questions or go back to any charts to do a deeper dive. At 4:30, they're going to ring a bell that's going to scare us all. And then that is the indication that we actually need to start moving out so the poor librarians can go home. But until then, like, are there any charts that people want to go back to? Are there follow-up questions? Yeah.
I have a question on the alternatives to stock. You talked about residential real estate, but I'm wondering if you have any information on investment real estate?
So commercial real estate, like in the aggregate, does tend to have higher risk reward trade-offs. In my other chart, I don't have it in here, but it's closer to stocks. So if you think like a diversified portfolio of like there's malls, there's office buildings, there's multifamily properties, those do have a higher return, but higher risk profile than residential real estate.
What about like smaller, like residential real estate?
This is all residential.
This is residential. This is all residential. I do think,
Okay.
I think that a professional real estate investor who is very diligent about expenses and rents can probably end up with a return that's something close to stocks, because you get to use leverage, you get to use debt. But most of us who have been investment properties are not super professional about it.
Can I just add to that?
Yeah.
As a landlord,
They are just very different because one is passive
Hmm,
and one is not.
yeah, interesting.
Being a landlord is a job.
Yeah.
Takes the time and your attention.
Yeah.
Stock market is a gift and that.
My real estate have been doing terribly.
Yeah, it's because of interest rates.
Fair.
Right, like the real estate sector in the aggregate is very impacted by interest rates, right? Like just think how mortgage rates flow through to housing prices. Even in Austin, it's like if rates stay this high, people's expectations for their selling price on their house need to be adjusted downward to come to that meeting of the minds, right? So that totally makes sense. What else?
okay, this is probably more of a talking to me about the psychology of this, maybe also the timing. So let's say I liked those columns with the bull and the bear market of going up. And you were describing as in those recessions, that when it's going down, you really don't want to sell because you're only selling at a low and that's not our goal. So if we never know when it's gonna end, that's the hard part. But if we had extra cash, like in our Wells Fargo,
Mhm.
then how and when do we know if it's good to dump, gift,
Yeah,
purchase, stock? How do we know when? Or is it just
Yeah.
and making sure we still have enough, or looking at the bigger, because there's always something going on, and whether it's political or COVID or something.
Yeah.
What's your advice
Yeah.
and timing?
Like watching people go through this, like basically kind of every 2 years, like it's. You're in the crisis part, right? Like you're in like the low part and you do an evaluation. How vulnerable am I to a layoff? You usually you usually have some sort of sense like, oh my gosh, if a company just announced layoffs, I need to get ready, right? Or my industry is laying people off, I need to get ready. Or you just have so you get a sense like, is there some money in that cash fund that is I'm willing to take a risk on?
Okay.
And if I'm wrong, I'm not gonna blow myself up. So it is like a real-time evaluation. How vulnerable am I right now? Based on whatever the crisis is that's precipitating the bear market. But and then it's like, oh yeah, like I also have the behavioral wherewithal to want to do this or to hold my nose and do it, right? Like it's not pleasant. And I acknowledge that the market might continue to go down, but
you at least know that you're buying it on a low,
Right.
which is exactly
right.
the basic stuff that I learned as a kid. Sell high, buy low.
Right.
But it may still, you're at least buying it lower than what it was.
Yeah.
So I liked that bit of how vulnerable to a layoff you are. I can also imagine how close are you to retirement?
Absolutely. Yeah.
Or willing to like, all right, we'll take this risk. Maybe it'll make us a little faster to retirement. Or if you're okay with another year and a half, but you also have that, you now own that stock that if you keep holding it, eventually it'll do this.
And if you've done a lot of the planning work, I think that's a benefit to like this group, or like working on this on a regular basis is you will very quickly be able to go through the checklist in your head. You're not starting from scratch in a crisis, not knowing what your budget is, not understanding like what a recession might look like. You're already prepared in a way. You're like, okay, like I'm willing to take this risk. I'm not taking it FOMO style. I don't understand the risk and I'm just like, right, like kind of like pushing it into the middle of the table, like poker chips. Like you in real time, like we can afford to put another 10,000 in. We'll be okay. And if we lose our job, we'll be okay. And we'll eat beans and rice. And we're ready to like take it way down, right? Like if you have kids in college and you're like, well, I have like $100,000 worth of tuition payments to make and I have $100,000 in the bank. Do you think I should put it in the market? We'd probably be like, yeah, probably not, right?
Okay.
But there's like a real-time evaluation that happens typically in that case. Really good question. You're right.
I just wanted to kind of add on to that point, like on this chart too, is, so one of the, I can't remember what the book I read, it's really old one, a little red book on value investing.
Yeah.
And like, one of the things as I was reading the book, oh yeah, I want to ask you, do you remember when index funds were created?
70s?
Okay, so like.
When
way
index
on
funds
the
Yeah.
Left
Yeah,
side.
70s. Yeah.
1970s?
Well, that's when they became commercially available, like through Vanguard and Global, yeah.
Don't forget to stop at Bates table and learn about the financial health clinic. I'm also gonna be like trying to post the events in like the AWIC meeting spaces online, so you guys know, especially about those classes that are hopefully gonna be restarting. So thank you, everybody.